Let's talk about a game changer for real estate investors, DSCR loans. If you've ever dreamed of building a rental property empire but felt stuck by traditional lending requirements, you're not alone. Many investors hit a wall when banks ask for mountains of paperwork, years of tax returns, and proof of a steady W-2 income. But what if there was a way to qualify for more properties, even if your personal income isn't picture perfect? Imagine this. You finally find the perfect rental property, one that could generate great cash flow and help you reach your financial goals. But when you go to the bank, you're met with endless questions about your job, your income, and your tax returns. For many, especially those who are self-employed, freelancers, or just starting out, this process can feel overwhelming and discouraging. For self-employed individuals or new investors, these traditional requirements can be a huge roadblock. Maybe your income fluctuates or your tax returns don't show the full picture of your financial health. Maybe you've reinvested profits back into your business, making your reported income look lower than it really is. Whatever the reason, getting approved for a conventional loan can feel impossible. But what if lenders focused less on your personal salary and more on the property itself? What if the main question was, does this rental make enough money to pay for itself? That's where DSCR loans come in. DSCR stands for Debt Service Coverage Ratio, and it's a powerful tool for investors. With a DSCR loan, the lender looks at the property's income and expenses, not just your personal finances. If the rental generates enough cash flow to cover the mortgage and other costs, you could qualify, even if your tax returns aren't impressive or your job situation is unconventional. This approach is designed specifically for real estate investors who want to grow their portfolios. This shift in focus can be a total game changer. It means you can scale your rental portfolio faster, without being held back by traditional income requirements. Even if you're just starting out or your tax returns don't tell the whole story, DSCR loans open the door to new opportunities. In this video, we'll break down exactly how DSCR loans work, what makes them different from conventional loans, and the key pros and cons you need to know. We'll also share tips on how to use DSCR loans strategically to buy more rentals and build long-term wealth. DSCR loans aren't just for big-time investors or real estate moguls, they're for anyone who's ready to take control of their financial future and stop letting paperwork stand in the way of their dreams. Whether you're a first-time investor or looking to expand your portfolio, this could be your secret weapon. Let's dive in and unlock the possibilities together. DSCR stands for Debt Service Coverage Ratio. It might sound like a mouthful, but it's actually one of the most important numbers in real estate investing, especially if you're thinking about buying a rental property or applying for a mortgage. Lenders, investors, and even property managers use DSCR to quickly measure whether a property is generating enough income to pay its debts. In other words, it's a financial health check for your investment. Think of DSCR as a simple way to see if a property's income covers its expenses and then some. It's like asking, does this property make enough money to pay the bills and still have a cushion left over? If the answer is yes, you're in good shape. The formula is straightforward. DSCR equals net operating income divided by total debt service. Or, in plain English, you take the money the property brings in after expenses and divide it by what you owe on the mortgage each month. Net operating income, or NOI, is what's left after you subtract all the necessary expenses from your rental income. That means things like property taxes, insurance, repairs, maintenance, and even management fees. It's the real profit your property generates before you pay the mortgage. Total debt service is simply your monthly mortgage payment, including both principal and interest. If you have more than one loan on the property, you'll add up all those payments to get your total debt service. Most lenders want to see a DSCR of at least 1.20 or 1.25. That means the property earns 20 to 25% more than what it costs to pay the mortgage. Why? Because it gives everyone a safety net. If rents drop or expenses go up, there's still enough income to cover the debt. A higher DSCR means more cash flow and a safer investment for both you and the lender. It shows you're not just scraping by, you've got breathing room. Investors love properties with strong DSCRs because they're less risky and more likely to weather tough times. For example, if your mortgage payment is $1,000 a month, a 1.25 DSCR means you need at least $1,250 in net operating income. That extra $250 acts as a buffer, protecting you from unexpected costs or vacancies. Think of DSCR as your property's report card. The higher the number, the better your grade. A strong DSCR tells lenders and investors that your property is performing well and is less likely to default on its loan. Lenders use DSCR to quickly decide if your deal is solid without having to dig into your personal finances or tax returns. It's a fast, objective way to judge the strength of your investment. So if you master this metric, you'll not only impress lenders, you'll also make smarter, safer investment decisions. Understanding DSCR puts you ahead of the game and sets you up for long-term success in real estate. Why do investors love DSCR loans? No personal income verification. Forget W-2s, tax returns, and pay stubs. Your property's numbers do the talking. This is huge for self-employed people or anyone with complex finances. The process is faster and simpler, focusing on your credit score and the property's DSCR. You can close in weeks, not months, a big advantage in competitive markets. DSCR loans also let you buy in an LLC, giving you liability protection from day one. Traditional lenders rarely allow this, but DSCR lenders expect it. They understand rental properties, multifamilies, and the investor mindset. You're finally using a tool built for real estate, not for homeowners. It's a partnership, not a battle. Who should use DSCR loans? Self-employed investors, freelancers, and business owners top the list. If your tax returns don't show your real earning power, DSCR loans let your investments speak for themselves. They're also perfect for investors who want to scale fast. No cap on finance properties like traditional loans. Newer investors with good credit and a solid down payment can get in the game too. Out-of-state investors benefit from the streamlined process and third-party appraisals. If you want to build a portfolio, not just dabble, DSCR loans are your ticket. It's about the deal, not your day job. Ready to apply? Here's what you need for a DSCR loan. First, a solid credit score, usually 640 minimum, but 720 plus gets the best rates. Next, a down payment of 20 to 30% is standard. Lenders want to see you have enough cash for the down payment, closing costs, and reserves, usually 6 months of payments. No need for W-2s, but you'll show a few months of bank statements. The property must meet the lender's DSCR threshold, typically 1.20 or higher, verified by an independent appraisal and rent schedule. Do your own rental comps to make sure the numbers work before applying. The deal must stand on its own. If you're prepared, approval is straightforward. DSCR loans are powerful, but not perfect. Expect higher interest rates and fees than conventional loans. This eats into your cash flow. You can't use them for your primary residence, they're for investment properties only. Lenders are strict about this. Don't try to cheat the system. DSCR lenders prefer standard rentals in good areas, not rural land or major fixers. Unusual properties are harder to finance. Watch for prepayment penalties. These loans often charge fees if you pay off or refinance too soon. If you plan to check the fine print, know the rules, and you'll avoid surprises. Weigh the costs against the benefits before you jump in. Here's how to use DSCR loans to grow your wealth. Focus on cash flow. Find properties with a DSCR of 1.5 or higher for a safety buffer. Once you hit the conventional loan limit, switch to DSCR loans to keep scaling. Use your existing cash flow to save for down payments on new deals. Buy properties in an LLC for legal protection. DSCR lenders make this easy. Consider a buy and hold strategy. Let tenants pay down your mortgage, then do a cash-out refinance after the prepayment penalty period. Use that equity to buy your next property. This creates a cycle where your portfolio funds its own growth. That's how you build a real estate empire. Let's dive into the world of DSCR loans by following the journey of Jane, a creative and ambitious freelance designer. Jane works from her cozy home office, balancing client projects and her dream of building wealth through real estate. Like many freelancers, her income is unpredictable, but she's determined to make her money work for her. Over the years, Jane has managed to save $50,000 and has built an impressive 740 credit score. However, when it comes to her tax returns, they don't reflect the true scope of her financial potential. The numbers look modest, and that's a problem when applying for traditional loans, which focus heavily on reported income. Jane spots a promising $200,000 duplex in a growing neighborhood. She envisions renting out both units and starting her journey as a real estate investor, but when she applies for a mortgage at her local bank, she's quickly turned down. The The bank can't look past her low reported income despite her savings and credit. Not one to give up, Jane discovers DSCR loans. Loans that focus on the property's ability to generate income, not just her personal finances. She meets with a DSCR lender who explains that what really matters is whether the rental income from the duplex can cover the mortgage and expenses. The duplex is expected to rent for $3,000 each month. After accounting for $1,000 in expenses like taxes, insurance, and maintenance, Jane's net operating income, or NOI, comes out to $2,000 per month. This strong rental potential is exactly what DSCR lenders are looking for. Jane applies for a $150,000 loan. With a monthly mortgage payment of $1,200, her DSCR, debt service coverage ratio, calculates to 1.67. That's well above the typical minimum requirement of 1.25, showing the property easily covers its debt. Confident in her numbers, Jane puts down her $50,000 savings as a down payment. The process moves quickly. She closes on the duplex in just 3 weeks, and the property is purchased under her LLC, giving her both flexibility and protection as a business owner. Now, Jane enjoys a steady $800 per month in cash flow, after all expenses and mortgage payments. She's building wealth and financial security, all without ever needing to show a traditional pay stub or W-2. With her first investment property under her belt, Jane is already planning her next move. She's researching new neighborhoods, analyzing deals, and mapping out her path to financial independence, one property at a time. That's the power and flexibility of DSCR loans, helping everyday people like Jane turn their real estate dreams into reality, no matter how unconventional their income may be. We've demystified DSCR loans and shown how they open doors for investors. They let you focus on great deals, not paperwork or perfect tax returns. Yes, rates are higher and you need a solid down payment, but these are just the rules of the game. With this knowledge, you can build a real estate business and legacy. Start analyzing deals, practice the DSCR calculation, and talk to lenders. Don't let traditional financing hold you back. Use DSCR loans to build the portfolio and cash flow you've always wanted. Now go make it happen.